Good afternoon, Miss. I am Mercy Fajundit, and now I'm going to continue the discussion in IAS 1, paragraph 45 to 54. So in paragraph 45, an entity shall retain the presentation and classification of items in the financial statement from one period to the next unless it is apparent following a significant change in the nature of entity's operation or a review of its financial statements that another presentation or classification would be more appropriate, having regards to the criteria for the selection and application of accounting policies in IAS 8. And an IFRS requires a change in presentation. So in paragraph 45, it means that from one period to another, the financial presentation will remain unless there are some changes in entities of the financial statement or any changes that IFRS requires. And for paragraph 46, for example, the significant acquisition or disposal or review of presentation of financial statement might suggest that the financial statement need to be presented differently. An entity change the presentation of its financial statement only if the change presentation provides information that is reliable and more relevant to users of the financial statement, and the revised structures is likely to continue so that the comparability is not impaired. So when making such changes in presentation, an entity reclassify its comparative information in accordance with paragraph 41 and 42. So in Coco Life, the policies have been consistently applied to all years presented in the Coco Life indicates that there are changes in their financial statement. So as you can see below, that the fair value lost on available for sale financial asset, and it reclassified to profit or loss because when a decline in the fair value of AFS financial asset has been recognized and other comprehensive income, and there is objective evidence that the asset is impaired. So the AFS financial asset accounts to profit or loss as a reclassification adjustment. And also there is a change in accounting policy of Coco Life, so it may be necessary to enhance the relevance and reliability of information contained in the financial statements. So by reclassify the information, it represents changes from one acceptable. By this, it will have an accurate financial statement that gives a clear understanding of the financial statement of Coco Life Insurance. In paragraph 47, the standards requires particular disclosures in the statement of financial position or of comprehensive income, in the separate statement of comprehensive income, or in the statement of changes in equities, and requires disclosure of other line items either in those statements or in the notes. So IAS 7 statement of cash flow set out requirements for the presentation of cash flow information. So here are some of the accounts that disclose in the financial statement: the subsidiary and associates in note 14, and the company's investment securities classified as AFS financial assets as disclosed in note 10 to the financial assets. So this provides additional information on balances and transaction and other relevant information in the financial statement. So you can see this in the financial position and financial statement of comprehensive income. So in paragraph 48, the standards sometimes use the term disclosure in a broad sense, encompassing items presented in the financial statement. Disclosure are also required by other IFRS unless specified to the contrary elsewhere in the standards or in another IFRS. Such disclosures may be made in the financial statement. So the term disclosure is a broad sense that it focused on identifying ways to ensure that the financial statement provide information that is relevant to investors that is communicated effectively. So the disclosure releases all the information about the Coco Life that may influence an investor's decision, and it reveals both positive and negative news, data, and operational details that impact the business. So you can see below the evidence that I get that there are items that disclose in the financial position, statement of comprehensive income, and also giving additional information in the notes of the items that disclosed. And the fair value is also disclosed in accordance with other relevant in PFRS. In paragraph 49, an entity shall clearly identify the financial statements and distinguish them from other information in the same published document. So, by identifying the financial statement that gives an overview of the financial result and condition of a business, we can distinguish this from other documents like the management plan of the Coco Life, because the financial statement has a complete set, such as the statement of financial position, statement of comprehensive income, changes in owner's equity, and the statement of cash flow, and also the note in financial statement. So we can find here the other information and also the accounting policy used of that entity. So like in Coco Life, management plan or revised management plan is a written document of the entity that outlines the aim and objective and also the strategies of the entity. In paragraph 50, IFRS apply only to financial statement and not necessarily to other information presented in annual report, a regulatory filing, or another document. So therefore, it is important that users can distinguish information that is prepared using IFRS from other information that may be useful to users, but it is not subject of those requirements. So like I said earlier, we can distinguish this from other documents because it has a complete set of financial statement. Users need to know that the importance and the use of financial statement because this will use to track the performance of a business, and like to be the income statement that show if the business generates profit. And also users need to know that the financial statement is different from other documents because financial statement has its written records of business activities and inflow and outflow of the money that may be useful to users. But some information or documents that not subject of IFRS is not part of financial statement and may be useful to users in some other way. So in paragraph 51, an entity shall clearly identify each financial statement and the notes. In addition, an entity shall display the following information prominently and repeat it when necessary for the information presented to be understandable. So first, the name of the reporting entity or other means of identification and any changes in that information from the end of the preceding reporting period, and also whether the financial statements of an individual entity or a group of entities, and also the date of the end of the reporting period or the period covered by the set of the financial statement. And letter D, the presentation currency as defined in IAS 21 and the level of rounding used in presenting amounts in the financial statement. So in paragraph 51, it is important to identify each financial statement with the respective information that presented in every financial statement that they do. By having the name of the reporting entity, this means it is your company's financial statement and no one can copy on that. So to know whether the company is owned by an individual entity or a group, it is also important to state and also the date and the currency of the entity's financial statement with the goal of using only one currency for ease of understanding. So we can see in the entity, the Coco Life, that they follow all the information that they need in their financial statement. In paragraph 52, an entity meets the requirements in paragraph 51 by presenting appropriate heading for pages, statement, notes, columns, and the like. Judgment is required in determining the best way of presenting such information. For example, when an entity presents the financial statement electronically, separate pages are not always used. An entity then presents the above items to ensure that the information included in the financial statement that can be understood. So through judgment, it creates an evidence obtained sufficient and appropriate for the auditing. So within the notes, the financial statement and entities are required to disclose both. So the judgment that management has made in the process of applying its accounting policy that have the most significant effect on the amount recognized in those financial statements. So in accordance with paragraph 51, the entity meet the requirement in presenting the heading with the name of the reporting entity, the date, the presentation currency through judgment, and we can determine if there are missing information that should put or if there is an information that should not put in the financial statement or financial position. So in paragraph 53, an entity often makes financial statement more understandable by presenting the information in thousands or millions of units of the presentation currency. So this is acceptable as long as the entity discloses the level of rounding and does not omit material information. So in the company principal transaction, they carried out the Philippine peso. So the foreign exchange risk arises primarily with respect to the transaction denominated in US dollar. So the entity converting the US dollar in Philippine peso. A reporting currency must be one currency, which make it easier to understand and follow the financial documents. So if the company does a business in other currency or has a subsidiary in other currencies, the different currency used must be converted to the reporting currency. So that was the paragraph 52 and 53. So in paragraph 54, as a minimum, the statement of financial position shall include line items that present the following amounts: the property, plant, and equipment, investment property, intangible asset, financial asset, excluding amounts shown under E, H, and I, investment account for using the equity method, letter F, biological asset, G, inventories, H, trade and other receivables, I, cash and cash equivalent, J, the total of asset classified as held for sales and asset included in the disposal group classified as held for sales in accordance with IFRS 5, non-current assets held for sales and discounted operation. And letter K, trade and other payables. Letter L, provisions. M, financial liabilities, excluding amounts shown under K and L. N, liabilities and assets for current tax as defined in IAS 12, income taxes. O, deferred tax liabilities and deferred tax asset as defined in IAS 12. P, liabilities included in disposal groups classified as held for sales in accordance with IFRS 5. Q, non-controlling interest presented within equity, and R, issued capital reserves attributable to owners of the parent. So the financial position included these account titles, but not all in the paragraph 54 are included in Coco Life financial position. So there are some accounts that are not found in Coco Life financial position, like biological asset, non-controlling interest, presented within equity, issued capital, and reserve are attributable to owners of the parent. So in PAS 1 does not prescribe the order or format of presenting items in the financial position. The foregoing is simply a list of items that are sufficiently different in nature or function to separate presentation, and the entity can add additional relevant information in terms of financial position. So that would be all for my report. I hope you learned something. Thank you.
So, good day everyone. My report will be starting to International Accounting Standards paragraph 55. So, in International Accounting Standard paragraph 55, the entity presents headings and subtotals. So, naani siya diri ang mga headings and subtotals, the statements of financial position and as of December 31, 2021 and 2020, and in amounting of Philippine peso. So, naga construct diri ang mga total assets, total liabilities, and equities. So in 56, International Accounting Standards, paragraph 56, the entity presents current and non-current assets and current and non-current liabilities, and it separates classification in its statements of financial position. As we take a look at it, it does not classify deferred tax assets for the liabilities as current assets or the liabilities. So as shown in the figure above or in the photo, there is the entity presents at this. So in paragraph in International Accounting Standards paragraph 57, as we take a look at it, we have not seen the standard applied, hence the standard prescribed the order of format in which an entity presents items. So as we go back to paragraph 54, it simply lists items that are sufficiently different in nature or function to warrant separate presentation in the statement of financial position. So in addition, we have not seen the additional line items as well as in International Accounting Standards paragraph 58, since it talks about additional line items which we didn't see in the entity. Therefore, I didn't conclude paragraph 57 and 58. So, in International Accounting Standard paragraph 59, in 2021, the company has reclassified certain land and buildings amounting to 23.5 million from property and equipment to investment property. So we can see here in the note 16, there was no similar transaction in 2020. So all the depreciations and amortization charges were reported as part of the depreciation and amortization under siya general and administrative expense account in the statements of comprehensive income. So we can also um, see here in notes 31. So the company recognized a gain on disposal of property and equipment totaling 0.330 million and 0.19 million in 2021 and 2020. So the use of different measurement bases of different classes of property, plant and equipment meets the nature of functions differs, and therefore that entity presents them as separate line items. So in International Accounting Standards paragraph 60, the entity presents current and non-current assets and current and non-current liabilities as separate classification in its statement of financial position. So here in 61, in International Accounting Standard, paragraph 61, no more than 12 months after reporting period expected to be recovered or settled. So the table below show an analysis of assets here, assets and liabilities, analyzed according to when they are expected to be recovered or settled. So therefore, an entity shall disclose the amount expected to be recovered or settled after more than or no more than 12 months for each assets and liability line item. That's why ginastate diri ana no collections and na mga claims receivables but still subject to final decision in the court and pending legal cases involving ownership. That's why they were unable to obtain sufficient audit evidence in 2020. Pero in 2021, they were able to obtain sufficient evidence on the judgment and assumptions applied made by the company's management. So to conclude, financial statements is no longer qualified as to this matter. So we will proceed to in International Accounting paragraph 62. The entity provides services within a clearly identifiable operating cycle. I noted here all the net current assets, as we can see, all the net current assets, non-current assets, and non-current, and liabilities. Separate classification of current and non-current assets and liabilities in the statement of financial position. So by distinguishing the net assets that are continuously circulating as working capital from those used in the entity's long-term operation. It also highlights assets that are expected to be realized within the current operating cycle and liabilities that are due for settlement within the same period. So in paragraph 63, the entity provides such financial positions and a presentation of assets and liabilities in increasing or decreasing order of liquidity provides information that is reliable and more relevant within 2021 and 2020. So in International Accounting Standard, paragraph 64, an entity is permitted to present some of its assets and liabilities using current and non-current classification and others in order of liquidity when this provides information that is reliable and more relevant. So as we can see here. So, in International Accounting Standard Paragraph 65, information about expected dates of realization of assets and liabilities is useful in assessing the liquidity and solvency of an entity. That's why I noted here that in IFRS 7 financial instruments, disclosure requires disclosure of the maturity dates of financial assets and financial liabilities, as we can see in the screen. And financial assets includes trade and other receivables, and financial liabilities includes trade and other payables. So information on the expected date of recovery of monetary assets such as inventories and expected date of settlement for liabilities such as provision is also useful whether ang assets or liabilities are classified as current and as non-current. So for financial assets and financial liabilities, management considered that the carrying amount of those short-term financial instruments appropriate with their fair values. So in 66, it provides with the statement or paragraph that an entity classified them all other current assets and non-current assets, as we can see in the screen. So in 67, this standard uses the non-current to include tangible, intangible, and financial assets of a long-term nature. It does not prohibit the use of alternative description as long as the meaning is clear. So in International 68, it provides the operating cycle of an entity, the time between the acquisition of assets for processing and their realization in cash or cash equivalents. So in 69, in International Accounting Standard Paragraph 69, it provides with the statement or paragraph that an entity classified them all other current liabilities and non-current liabilities. So in wait lang. So this is paragraph 70, but nakabutang na siya dirag 69. And in International Accounting Standard paragraph 70 provides current liabilities that are part of working capital used in entity's normal operating cycle. So in 71, um, other current liabilities are not settled as part of the normal operating cycle but are due for settlement within 12 months after the reporting period or held primarily for the purpose of trading. That's why example of this is the income taxes. So in International Accounting Paragraph 72, entity classify its financial liabilities as current. So when they are due to settle within 12 months after the reporting period, and as we note, we had examples of Coco Life financial liabilities here. So in International Accounting Standards paragraph 73, the company has elected not to recognize lease liabilities for short-term leases. On the other hand, any reimbursement that the company can be virtually certain to collect from a third party with respect to the obligation is recognized as separate asset, not exceeding the amount of related provision. So here in 74, in International Accounting Standard paragraph 74, an entity breaches a provision of a long-term loan agreement or before the end of reporting period with the effect that the liability becomes payable on demand. It classifies that liability as current even if lender agreed. After the reporting period and before the authorization of the financial statement for issue not to demand payment as a consequence of the breach, an entity classifies the liability as current because at the end of the reporting period it does not have an unconditional right to defer its settlement for at least 12 months after the date. So, in International Accounting Standards paragraph 75, an entity classifies the liability as non-current if the lender agreed by the end of the reporting period to provide a period of grace ending at least 12 months after the reporting period within which the entity can rectify the breach and during which the lender cannot demand immediate repayment. So here. In International Accounting Standard, paragraph 76, loans classified as current liabilities. If the following events occur between the end of the reporting period as within 1 year and after 1 year but no more than 5 years, management is of the opinion that losses, if any from those items, will not have material effect on the company's financial statements. So there are contingent liabilities that may arise in the normal course of the company's operation which are not reflected in the financial statements. So in 77 and 78, naa diri ang tanan nga notes here, ang mga assets, liabilities, and equity. So here are the liabilities. Nagikan siya sa notes, drag down. So, in International Accounting Standards, paragraph 79, entity shall disclose this following in the statement of financial position or in the notes for each class of share capital: the number of shares authorized, the number of shares issues and fully paid and issues but not fully paid, par value per share or that shares have no par value. A reconciliation of the numbers of shares outstanding at the beginning and at the end of the period, shares in the entity held by the entity or by its subsidiaries or associates, and shares reserved for issue under options and contracts for the sale of shares, including terms and amounts. So, in International Accounting Standards, paragraph 80 and 80A, in 80, an entity without share capital such as partnerships or trust disclose information equivalent to that required by paragraph. And in paragraph 80A, an entity has reclassified apputable financial instruments classified as an equity instruments and an instruments that imposes on the entity an obligation to deliver to another party and a pro rata share of the net assets of the entity only on liquidation and is classified as an equity instruments between financial liabilities and equity. So it shall disclose the amount reclassified into and out of each category and the timing and reason for that classification. So dara siya. So in International Accounting Standards paragraph 81, an entity shall present all items, and the entity presents all items on income and expenses recognized in a period in a single statement of comprehensive income. So dara siya. So in International Accounting Standards paragraph 82, the statement of comprehensive income includes line items that presents the following amounts for the period of revenue, finance cost, share of profit or loss of associate and joint ventures accounted for using the equity method, tax expense, a single amount comprising the total of and profit or loss, share of the other comprehensive income of associates and joint ventures accounted for the using of equity methods and total comprehensive income. So, in 83, parties are considered to be related if one party has the ability to control the other party. So, this party, mao ni siya, ay darang 83. Darang 84. 84 na siya instead of 83. So, the entity present in a separate statement of comprehensive income the line items. And in International Accounting Standards paragraph 85, the entity presents headings and subtotals in the statement of comprehensive income, and such presentation is relevant to an understanding of entity's financial position. So here they present headings and subtotals, and we didn't say any additional line items, and this Coca Life Insurance presentation is relevant to an understanding of the entity's financial position. So in 86 and 87, as we take a look at it, we have not seen the standard applied. Hence, the standard prescribed the order of format in which an entity presents items. So as we go back to paragraph 86, the entity did not include additional line items in the statement of comprehensive income and in the separate statement of comprehensive income. So in addition, we had not seen the additional line items since it talks about additional line items which we didn't see in the entity. So therefore, I didn't include paragraph 86. Also in International Accounting Standard paragraph 87, the entity shall did not present any items of income or expense as extraordinary items or in the statement of comprehensive income or the separate statement of comprehensive income or in the notes. That's why I didn't conclude in the paragraph 87. So in 88, an entity recognized particular items outside profit or loss in the current period, and the correction of errors and the effect of changes in accounting policies did not have those circumstances, and other IFRS required or permit components of other comprehensive income that met the framework's definition of income or expense to did not excluded from profit or loss. So here is the um a International Accounting Standards paragraph 89. An entity recognized particular items outside profit or loss in the current period, and the correction of errors and the effect of changes in accounting policies did not have those circumstances, and other IFRS requires to permit mao na dito siya ganiha. So in here So 90 ni siya ang other ang so paragraph 90 na siya, the other comprehensive income. Ay wait. There ang 90 day. Then here is the 91. So the 91, an entity may present components of the entity presents components of other comprehensive income net of related tax effects. So there. And in 92, an entity shall disclose reclassification adjustment relating to components of other comprehensive income. So here is the International Accounting Standards paragraph 93. The entity previously recognized in other comprehensive income are reclassified to profit or loss. Such reclassifications are referred to in this standards as reclassification adjustment. On the other hand, International Accounting Standard paragraph 94, the entity may present reclassification adjustment in the statement of comprehensive income or in the notes. The entity presenting reclassification adjustment in the notes presents that the components of other comprehensive income after any related reclassification adjustment. So here are the evidence that we do have the entities reclassified to profit and loss and adjustments. So in International Accounting Standard paragraph 95, the reclassification adjustment arise on the recognition of available for sale financial assets. As of December 31, 2021 and 2020, management assessed that there is no additional impairment on its AFS financial assets. The related gains and losses from sale of these financial assets are presented under investment income account in the statement of comprehensive income. So here in 96, the entity reclassify adjustment that does not arise on changes in evaluation on actuarial gains and losses. These components are recognized in other comprehensive income and are not classified to profit or loss in subsequent periods. And here, actuarial gains and losses are reported in the retained earnings in the period that they are recognized as other comprehensive income. So also we had the statement of comprehensive income in the notes. So there siya. So here in International Accounting paragraph 99 and 100, the entity presents analysis of expenses recognized in profit or loss using classification based on either their nature or their function within the entity, whichever provides information that is reliable and more relevant. And the entity presents analysis in paragraph 99 here. In the statement of comprehensive income or in the separate statement of comprehensive income. So here in International Accounting Standards paragraph 101 and 102, the entity expenses are subclassified to highlight components of financial performance that may differ in terms of frequency, potential for gain or loss, and predictability. So in internal and also here In International Accounting Standards, paragraph 102, the entity aggregates expenses within profit or loss according to their nature, like for example, depreciation, employee benefits, and does not relocate them among functions within the entity. So this method may be simple to apply because no allocations of expenses to functional classifications are necessary. So in International Accounting Standards, paragraph 103, it states that the second form of analysis is the function of expense, methods, and classified. So this method can provide them more relevant information to users than the classifications of expenses by nature, but allocating cost to functions may require arbitrary locations and involve considerable judgment. An example of classification using the function of expense method is as photos as follows. So in 104, um, here is the entity classifying expense by functions disclosed additional information on the nature of expenses, including depreciation and amortization and expense and employee benefit expense. So for my last report, here is the 105. An entity choice between the function of expense method depends on historical and industry factors and the nature of the entity. However, because information on the nature of expense is useful in predicting future cash flow, additional disclosure is required when the entity of expense classification. So, in paragraph 105, employee benefits has the same meaning as an IAS. So, I think that's all for my report. Thank you for listening.
Hi everyone, my name is Trenlon Humawas, and now it's my turn to report the other 52 paragraphs in IAS 1 and some of the paragraph of IAS 7. So, I will be presenting these paragraph as well as the evidence that we have gathered in our chosen audited financial statements, which is the Coco Life audited by PNA, Punong Bayad and Aurelio. Alright, so let's start with the statement of changes in equity. So information to be presented in the statement of changes in equity, paragraph 106, it says that an entity shall present a statement of changes in equity as required by paragraph 10. The statement of changes in equity includes the following information. So on paragraph 10, we could see the complete set of financial statements, which also consist the statement of changes equity. So this audited financial statements comply that paragraph. We have letter A, total comprehensive income for the period showing separately the total amounts attributable to owners of the parent and to non-controlling interests. So our chosen financial statements or company is the parent company, as it was explicitly um, noted on the notes of financial statements that notes to financial statements that they are a parent company with subsidiaries and associates. And then we also have for each component of equity, the effects of retrospective application or retrospective restatement recognized in accordance with the IAS 8. And letter D, we have for each component of equity a reconciliation between the carrying amount at the beginning of and the end of the period, separately disclosing changes resulting from letter A, profit or loss, letter B, other comprehensive income, then letter C, transaction with the owners and the capacity as owners, showing separately contributions by and distribution to owners and changes in ownership interest in subsidiaries that do not result in a loss of control. And we also have paragraph 108. These are somehow the same. In paragraph 106, the components of equity include, for example, each class of contributed equity, the accumulated balance of each class, of other comprehensive income, and returned in earnings. So this is our evidence for that. So that's it. That's the statement of the changes in equity. So there's a title, there's each of the class, and their amounts, and there are also the notes there for the cross-referencing. And this one is the unaudited key financial information of the significant subsidiaries. So as you can see that these are the subsidiaries and associate of Coco Life Company. Right, so now let's have 106p, that for each component of equity, the effects of retrospective application or retrospective restatement recognized in accordance with IAS 8. And also with 110, the IAS 8 requires retrospective adjustment to effect changes in accounting policies to the extent practicable, except when transition provisions in another IFRS requires otherwise. IAS 8 also requires restatements to correct errors to be made retrospectively to the extent practicable. Retrospective adjustments and retrospective restatements are not changes in equity, but they are adjustment to the opening balance of retained earnings, except when an IFRS requires retrospective adjustment of another component of equity, paragraph 160. So that's why I just put them together, the 106B and 110, since they are somehow the same. They pertain to the IAS 8. Um, so on paragraph 106B again, it requires disclosure in the statement of changes in equity of the total adjustment to each component of equity resulting from changes in accounting policies and separately from corrections of errors. So the adjustments are disclosed for each prior period and the beginning of the period. Alright, so as you can see here, they put the the adoption of the amended PFRS. So it also includes the PAS 8 amendments, accounting estimates, definition of accounting estimates that will be effective from January 1, 2022. Right, so now let's go back to 107. So on the 107, it says an entity shall present either in the statement of changes in equity or in the notes. So we can choose either of them. Maybe it could be on the equity statement of changes in equity or on the note. So here in our evidence, we look for it on the note. And then the amounts of dividends recognized as distribution to owners during the period and related amount of dividends per share. So it was noted there that there were no dividends declared by the company on 2021 and 2020. So this is a limitation on dividend declaration that was in the note 5.4. Alright, so let's go back to 108 again. So in paragraph 106, the components of equity include, for example, each class of contributed equity, the accumulated balance of each class of other comprehensive income, and retained earnings. So this is the contributed equity for this audited financial statement. So this is on the note 2.18. Right. So now for IAS 111. So we're already on the statement of cash flows. Cash flow information provides users of financial statements with a basis to assess the ability of the entity to generate cash and cash equivalents, and the needs of the entity to utilize those cash flows. IAS 7 sets out requirements for the presentation and disclosure of cash information. So, in reference to this one, we can pertain as well the paragraph 10, which gives the complete set of financial statements. And then, as you can see, we have the evidence of the cash flows for the comparative year and the current year, and then also in the notes, they are separately noted there. And yeah, don't worry, we will be tackling more about cash flows on the IAS 7, so we only have one paragraph for that, since it will be specifically tackled on the IAS 7. Okay, so let's move forward on the notes. Okay, so notes, the structure for that. So let's start with paragraph 112 that says the notes shall A. present information about the basis of preparation of the financial statements and the specific accounting policies used in accordance with the paragraph 117 to 124. Letter B. disclose the information required by IFRS that is not presented elsewhere in the financial statements, and provide information that is not presented elsewhere in the financial statements but is relevant to understanding of any of them. So you can see we have we have used this evidence basis of preparation of the financial statements. So that is our on the notes. So they explicitly says there their basis for financial information. They said that they prepared in accordance with the PFRS, that's Philippine Financial Reporting Standards, and adapted the FRSC from the pronouncements issued by the International Accounting Standards Board and approved by the Philippine Board of Accountancy. So here we have 113 and 114, letter C. So let's check this out. So an entity shall, as far as practicable, present notes in a systematic manner. An entity shall cross-reference each item in the statements of financial position and comprehensive income in a separate statement of comprehensive income if presented, and if the statement of changes in equity and cash flows to any related information in the notes. However, it stated on the paragraph 115 that in some circumstances it may be necessary or desirable to vary the order of specific items within the notes. For example, an entity might combine information on changes in fair value recognized in profit or loss with information on maturities of financial instruments, although the former disclosures relate to the statement of comprehensive income or separate statement of comprehensive income, and the latter relate to the statement of financial position. Nevertheless, an entity retains a systematic structure for the notes as far as practicable. So there's a word there, practicable. So if it's practicable to use a systematic manner, then please do so. And then in 114, it says that an entity normally presents notes in the following order to assist users to understand the financial statements and to compare with financial statements of the other entities. So, statement of compliance with the IFRS, so we have already shown that one. Summary of significant accounting policies, applied, see paragraph 117. So, we will be showing this one as well later when we're on the paragraph 117 already. So, letter C, supporting information for items present in the statement of financial position and of comprehensive income, in the separate statement of comprehensive income, and in each item of changes in equity and cash flows, in the order in which each statement and each line is presented. Okay, so this is our so that's our evidences. Right, so 114, paragraph 114 A, B, and the rest of the enumeration here. So on letter D, other disclosure including contingent liabilities, non-financial disclosures like financial risk management objectives and policies. That also refers to the IFRS 7. So we have evidences for that. So that is our evidences. We have summary of significant accounting policies. This is number 2. The basis for preparation of financial statements, statement of compliance and with Philippine Financial Reporting Standard, the amendments for PAS 37, and the risk management objective and policies, and also their strategies and structure. Right, so 117B and then 122. For 117B, it says that
it says that the an entity shall disclose in the summary of significant accounting policies the other accounting policies used that are relevant to understanding of the financial statements. And on 122, an entity shall disclose in the summary of significant accounting policies or other notes the judgments apart from those involving estimation. So we can also check this one on 125, paragraph 125 rather. The statement was made in the process of applying the entity's accounting policies and that have the most significant effect on the amounts recognized in the financial statements. So we have this as our evidences, the summary of accounting judgments and estimates. And for 199, we have this one. In deciding whether particular accounting policy should be disclosed, management considers whether disclosure should assist users in understanding how transaction, other events, and conditions are reflected in reported financial performance and financial position. Disclosure of particular accounting policies is especially useful to users when those policies are selected from alternatives allowed in IFRS. So, and then 122. Okay, so this is the same that I read earlier, and then for 123. In the process of applying the entity's accounting policies, management makes various judgments, apart from those involving estimations, that can significantly affect the amounts it recognizes in the financial statement. For example, management makes decision in determining A, whether financial assets are held to maturity investments, or B, when substantially all the significant fees and rewards of ownership or financial assets are transferred to other entities, or letter C, whether in substance particular sales of goods or financing arrangements and therefore do not give rise to revenue. And also letter D, whether the substance of relationship between the entity of special purpose and entity indicates that the entity controls the special purpose entry. So we have here our evidences as well. We have critical management judgments in applying accounting policies. And then we have 120. Okay, for 120 it says that each entity considers the nature of its operation and the policies that the users of its financial statements would expect to be disclosed for the type of entity. For example, users would expect an entity subject to income taxes to disclose its accounting policies for income taxes, including those applicable to deferred tax, liabilities, and assets. When an entity has significant foreign operations and transactions in foreign currencies, users would expect disclosure of accounting policies for the recognition of foreign exchange gains and losses. So in the presentation, we have highlighted there that a deferred tax is accounted for using liability method on temporary differences at the end of the reporting period between the tax base of assets and liabilities and their carrying amount of financial reporting purposes. For 121, it says that an accounting policy may be significant because of the nature of the entity's operations, even if the amounts for current period and prior periods are not material. It is also appropriate to disclose each significant accounting policy that is not specifically required by IFRS, but the entity selects and applies in accordance with IAS 8. So we have already noted this one as well. And then IAS 123 and 125. So these are example of 123 and 125. So for the 125, this is for the sources of estimation uncertainty. So an entity shall disclose information about assumptions it makes about the future and other major sources of estimation uncertainty at the end of the reporting period that have a significant risk or resulting in material adjustment to the carrying amount of assets and liabilities within the next financial year. In respect of those assets and liabilities, the note shall include the details of A, their nature, and letter B, the carrying amount as at the end of reporting period. And then, yes, so this is one of our evidences. Okay, now for 124. It says that some of the disclosures made in accordance with the paragraph 122 are required by other IFRS. For example, IAS 27 requires an entity to disclose the reasons why the entity ownership interest does not constitute control in respect of an investee that is not subsidiary, even though more than half of its voting or potential voting power is owned directly or indirectly through subsidiaries. IS 40 investment property per, requires disclosure of the criteria developed by the entity to distinguish investment property from owner occupied property and from property held for sale in the industry course of the business when classification of the property is difficult. Right, so for 126, okay, we have determining the carrying amount of some assets and liabilities requires estimation of the effects of uncertain future events and those assets and liabilities at the end of reporting period. So we also have highlighted there the analysis of the carrying investment property, carrying amount of investment properties, property and equipment, right of use assets, and intangible asset as presented in notes 16, 17, 18, and 19 respectively. So 134 and 135. Okay, so for 134 and 135, it pertains to the capital. So an entity shall disclose information that enables users of its financial statements to evaluate the entity's objectives, policies, and processes for managing capital. And also for 135, to comply with paragraph 134, the entity disclose the following: the qualitative information about its objectives, policies, and processes for managing capital. That also includes a description of what it manages as a capital when an entity is subject to externally imposed capital requirements, the nature of those requirements, and how those requirements are incorporated into the management of capital, and lastly, how it is meeting its objectives for managing capital. And then the summary of quantitative data about what it manages at capital, and C, any changes in A or B from the previous period. Letter D, whether during the period is complied with any externally imposed capital requirements in which it is subjective, and letter E, when the entity has not complied with such externally imposed capital requirements, the consequences of such non-compliance. Alright, so for 136, so an entity may manage capital in a number of ways and be subject to a number of different capital requirements. So this is for our 136. So these are the capital requirements that we have also gathered from the financial statements. For 137, an entity shall disclose in the notes an entity shall disclose in the notes the amount of dividends proposed or declared before the financial statements were authorized for issue, but not recognized as distribution to owners during the period, and related amount per share, and the amount of any cumulative preference dividends not recognized. So this is our evidence reserved for policyholders' dividends. And limitation on dividend declaration. And then for 138, an entity shall disclose the following if it does not disclose elsewhere information published with the financial statements. So the domicile and legal form of the entity, if the country of incorporation, and the address of its registered office or principal place of business if different from the registered office, a description of the nature of the entity's operation and its principal activities, the name of the parent and the ultimate parent of the group, and if it is limited life entity, or information regarding the length of its life. So for this one, for the letter D, it was explicitly says that it is complying with the going concern entity. So as you can see, there's the information for the corporation and the subsidiaries and associates. So which means that this corporation is the parent company. And this one, in connection with our audits, we have performed procedures to evaluate management plans as the likelihood of improving the situation and the feasibility under the circumstances. So this one is actually from the Punong Bayan and Arroyo opinions that this would be a going concern entity. And then the rest of the paragraph on paragraph 1, transition and effective date, it started from paragraph 139 to 139F, and then withdrawal of IS1, revised on 2003, 140. So these are only the date of the transition on the amendments of the different um, paragraph in AS1. Alright, so at this juncture, we will now be talking on the IS7. So it's just so few of them since I am only assigned from 1 to 14. Okay, so let's start with the objective. Alright, so objective information about the cash flows of an entity is useful in providing users of financial statements with basis to assess the ability of the entity to generate cash and cash equivalents and the needs of the entity to utilize those cash flows. The economic decisions that are taken by users require an evaluation of the ability of an entity to generate cash and cash equivalents and the timing of certainty of their generation. The objective of the standard is to require the provision of information about the historical changes in cash and cash equivalents of an entity by means of statement of cash flows, which classifies cash flows during period from operating, investing, financing activities. Right. So for paragraph 1, the scope of it is that an entity shall prepare a statement of cash flows in accordance with the requirements of the standard and shall present its integral part, financial statements, for each period which financial statements are presented. And then paragraph 2, that the standard supersedes IS 7 Statement of Changes Financial Position approved in July 1977. And then paragraph 3, it says that the financial statements are interested in how the entity generates uses of cash and cash equivalents. And for the benefits of cash flow information, in paragraph 4, it says that the financial statements provides information that enables users to evaluate the changes in net assets of an entity, its financial structure, so that also includes the liquidity and solvency, and its ability to affect the amounts and time and cash flows in order to adapt the changing circumstances and opportunities. And cash flow information is useful in assessing the ability of the entity to generate cash and cash equivalents and enables users to develop models to assess and compare present value of the future cash flow and different entities. It also enhances the comparability of the reporting of operating performance. And then number 5, paragraph 5, it says that historical cash flow information is often used as an indicator of the amount, timing, and uncertainty of future cash flows. Alright, so here on the definition paragraph 6, so it defined the definition for cash that comprises cash in hand and demand deposits, cash equivalents that are short term, highly liquid investment that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. The cash flow, the inflow and outflow of cash and cash equivalents, operating, investing, and financing activities that will be tackled on the next reporter. So for this cash and cash equivalents, it says that cash equivalents are held for the purpose of meeting short-term cash commitments rather than the investment or other purposes. And for the cash, that's for the cash equivalents. And therefore, for example, an investment to qualify as a cash equivalent, it must be readily convertible to known amount of cash and subject to insignificant risk of changes in value. Therefore, an investment normally qualifies as a cash equivalent only when it has a short-term maturity. So let's say 3 months or less from the date of acquisition. Alright, so presentation of statement and cash flows. So the statement of cash flow shall report cash flow during the period classified by operating, investing, and financing activities. That's for the paragraph 10. In paragraph 11, an entity presents its cash flows from operating, investing, and financing activities in a manner which is most appropriate to its business. Classification by activity provides information that allows users to assess the importance of those activities on the financial position of the entity and the amount of its cash and cash equivalents. This information may also be used to evaluate the relationship among those activities. And then 12, a single transaction may include cash flows that are classified differently. Okay, now for the operation activities, we have 13 and 14. So for the 13, it says the amount of cash flows arising from operating activities is a key indicator that of the extent to which the operations of the entity have generated sufficient cash flows to repay loans, maintain the operating capability of the entity, pay dividends, make new investments without recourse to external sources of financing. So information about the specific components of historical operating cash flows is useful in conjunction with other information in forecasting future operating cash flows. And then the last paragraph, this is a cash flow from operating activities that are primarily derived from the principal revenue producing activities of the entity. So therefore, generally result from the transaction and other events that enter into determination of profit or loss. So for example, cash flows from operating activities, they may be cash receipts from sales of goods and rendering services, or royalties, fees, commissions, and other revenue, or cash payments to suppliers for goods and services. So there are a lot more depending on what type of business you are taking. So that's it for my part. So we've tackled from IAS 1 of paragraph 106 up until the IAS 7 paragraph 114. So that's it for my reporting. That's it for my part. Thank you so much for listening, everyone. So I'll be now giving the floor to the next reporter.
Good day everyone, I am Idere Obando and I'll be the one to continue the report on IAS 7, paragraph 14 up to the last paragraph. Cash flows from operating activities are primarily derived from the principal revenue producing activities of the entity. Therefore, they generally result from the transactions and other events that enter into the determination of profit or loss. Examples of cash flows from operating activities are cash receipts from the sale of goods and rendering of services, cash receipts from royalties, fees, commissions, and other revenue, cash payments to suppliers for goods and services, cash payments to and on behalf of employees, cash receipts and cash payments of an insurance entity for premiums and claims, annuities and other policy benefits, cash payments or refunds of income taxes unless they can be specifically identified with financing and investing activities. And lastly, the cash receipts and payments from contracts held for trading or dealing purposes. Some transactions, such as the sale of an item of plant, may give rise to a gain or loss that is included in the recognized profit or loss. The cash flows relating to such transactions are cash flows from investing activities. However, cash payments to manufacture or acquire assets held for rental to others and subsequently held for sale as described in paragraph 68A of IAS 16, which is the property, plant, and equipment, are cash flows from operating activities. The cash receipts from rents and subsequent sales of such assets are also cash flows from operating activities. So we attach the evidence here, the operating activities of cash flows operating activities of Coco Life. We have the gain on sale of available for sale financial assets, the gain on sale of investment properties, the gain on sale of real estate inventories, and the gain on sale of property, plant, and equipment. Next, paragraph 15. An entity may hold securities and loans for trading or dealing purposes, in which case they are similar to inventory acquired specifically for resale. Therefore, cash flows arising from the purchase and sale of dealing or Trading securities are classified as operating activities. So sa cash flows diri sa Coco Life is they don't have that they didn't present the trading securities. So it means na wala sila ani. And paragraph 16, the separate disclosure of cash flows arising from investing activities is important because the cash flows represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. Only expenditures that result in recognized asset in the statement of financial position are eligible for classification as investing activities. Examples of cash flows arising from investing activities are A. The cash payments to acquire property, plant, and equipment, intangibles, and other long-term assets. These payments include those relating to capitalized development costs and self-constructed property, plant, and equipment. B. The cash receipts from sales of property, plant, and equipment, intangibles, and other long-term assets. Cash payments to acquire equity or debt instruments of other entities in joint ventures. Cash receipts from the sales of equity or debt instruments of other entities and interests in joint ventures. Cash advances and loans made to other parties. The cash receipts from the repayment of advances and loans made to other parties. Cash payments for future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes, or the payments are classified as financing activities. And lastly, cash receipts from future contracts, forward contracts, option contracts, and swap contracts, also except when the contracts are held for dealing or trading purposes, or the receipts are classified as financing activities. When a contract is accounted for as a hedge of an identifiable position, the cash flows of the contract are classified in the same manner as the cash flows of the position being hedged. So our proof is the next. Here are our evidence. We have the acquisition of financial assets at FPBL, AFS Financial Assets, the investment subsidiaries, property, plant, and equipment, investment properties, intangible assets, and the proceeds from the sale of financial assets at FVPL, AFS Financial Assets, investment properties, property and equipment, real estate inventories, investment in associate, the interest received, dividends received. Then paragraph 17, the separate disclosure of cash flows arising from financing activities is important because it is useful in predicting claims on future cash flows by providers of capital to the entity. Examples of cash flows arising from financing activities are cash proceeds from issuing shares or other equity instruments. Then, cash payments to owners to acquire or redeem the entity's share, cash proceeds from the issuing debentures, loans, notes, bonds, mortgages, and other short-term or long-term borrowings, cash repayments of amounts borrowed, and cash payments by a lessee for the reduction of the outstanding liability relating to finance lease. So our proof here, the Coco Life has also had only the repayment of lease liabilities. Paragraph 18, an entity shall report cash flows from operating activities using either. So there is a paragraph 18, 19, and 20 they are all interrelated. In paragraph 18, it's talk about that there are two methods of presenting operating activities. The first is the direct method, whereby major classes of gross cash receipts and gross cash payments are disclosed. And the second one is indirect method, whereby profit or loss is adjusted For the effects of transactions of non-cash nature, any deferrals or accruals of past or future operating cash receipts or payments, and items of income or expense associated with investing or financing cash flows. Paragraph 19, entities are encouraged to report cash flows from operating activities using the direct method. Under the direct method, information about major classes of gross cash receipts and gross cash payments may be obtained either from the accounting records of the entity or by adjusting sales, cost of sales, and other items in the statement of comprehensive income for the changes during the period in inventories and operating receivables and payables, and also other non-cash items and other items for which the cash effects are investing or financing cash flows. Next slide is our evidence. Evidence in paragraph 20. Under the indirect method, the net cash flow from operating activities is determined by adjusting profit or loss for the effects of changes during the period in inventories and operating receivables and payables, non-cash items such as depreciation, provisions, deferred taxes, unrealized foreign currency gain and losses, and undistributed profits of associates, and all other items for which the cash effectives are investing or financing cash flows. So, dari kay nag-use ang cook life of indirect method, which is nag-start siya sa profit before tax, and they have adjustments for income, interest income, and interest expense. And they also present here the non-cash items, which is the depreciation and amortization. And also, they have cash paid for income taxes. And the unrealized fair value losses on financial assets at FVPL, the net, and unrealized foreign exchange losses or gains, net. Mano siyang indirect method. Paragraph 21, an entity shall report separately major classes of gross cash receipts and gross cash payments arising from investing and financing activities, except to the extent that cash flows described in paragraph 22 and paragraph 24 are reported on a net basis. Our evidence, cash flows from investing activities, which is nakakuan siya separate ang acquisition sa from investment and investing rather, and the proceeds from sales. Paragraph 22, cash flows arising from the following operating, investing, or financing activities may be reported on a net basis. A. The cash receipts and payments on behalf of customers when the cash flows reflect the activities of the customer rather than those of the entity, and cash receipts and payments for items in which the turnover is quick, the amounts are large, and the maturities are short. So, diri naka-among gikuan nga evidences, nakakuan yun siya, naka-net basis, wala sila gitastag sa pagbutang sa cash flows. But, makita rin siya, kaya naman tayo naka-indicate nga notes. Paragraph 23, examples of cash receipts and payments referred to in paragraph 2A are the acceptance and repayment of demands and deposits of the bank, funds held for customers by an investment entity, and rent collected on behalf of and paid over to the owners of properties. So, dure nakita mo ng red nga box, we have the gain on sale of investment properties. Paragraph 23A. Examples of cash receipts and payments referred to in paragraph 22B are advances made for and the prepayment of principal amounts relating to credit card customers, the purchase and sale of investments and other short-term borrowings, for example, which have a maturity period of 3 months or less. So diri kay we have the acquisition of investment in subsidiaries, the acquisition of investment properties, the proceeds from sale of investment properties, and also the proceeds of sale in investment in associate. Paragraph 24, cash flows arising from each of the following activities of a financial institution may be reported on a net basis. Cash receipts and payments for the acceptance and repayment of deposits with a fixed maturity date. The replacement of deposits with and withdrawal of deposits from other financial institutions. And lastly, the cash advances and loans made to customers and the repayment of those advances and loans. Paragraph 25, cash flows arising from transactions in a foreign currency shall be recorded in an entity's functional currency by applying to the foreign currency amount the exchange rate between the functional currency and the foreign currency at the date of the cash flow. So we have inserted the evidence here as seen in notes 2.21, the foreign currency transactions and translations. The accounting records of the company are maintained in Philippine pesos. Foreign currency transactions during the year are translated into the functional currency at the exchange rate which approximate those prevailing on transaction dates. Paragraph 26. The cash flows of a foreign subsidiary shall be translated at the exchange rate between the functional currency and the foreign currency at the dates of the cash flow. So, related on is lesson 25. Paragraph 27. Cash flows denominated in a foreign currency are reported in a manner consistent with IAS 21, the effects of changes in foreign exchange rates. This permits the use of an exchange rate that approximates the currency transactions that approximates the actual rate rather. Paragraph 27. Cash flows denominated in a foreign currency are reported in a manner consistent with IAS 21, the effects of changes in foreign currency exchange rates. This permits the use of an exchange rate at the approximate of the actual rate. For example, the weighted average exchange rate for a period may be used for recording foreign currency transactions or translations of the cash flows of a foreign subsidiary. However, IAS 21 does not permit use of the exchange rate at the end of the reporting period when translating the cash flows of a foreign subsidiary. So, the evidence we inserted, we have the US dollar and it converted to Philippine pesos. Paragraph 28. Unrealized gains and losses are arising from changes in foreign currency exchange rates are not cash flows. However, the effect of exchange rate changes on cash and cash equivalents held or due in a foreign currency is reported in the statement of cash flows in order to reconcile cash and cash equivalents at the beginning and the end of the period. This amount is presented separately from cash flows from operating, investing, and financing activities and includes the differences. If any had those cash flows been reported at the end of period exchange rate. So from the notes put ning evidence, foreign currency gains and losses resulting from the settlement of such transactions and from the translation at year-end exchange rate of monetary assets and liabilities denominated in foreign currencies are recognized in profit or loss section of the statement of comprehensive income. Paragraph 31. Cash flows from interest and dividends received and paid shall each be disclosed separately. Each shall be declassified in a consistent manner from period to period as either operating, investing, or financing activities. Paragraph 32. The amount of interest paid during a period is disclosed in the statement of cash flows, whether it has been recognized as an expense in profit or loss or capitalized in accordance with IAS 23 borrowing costs. So sa among evidence, we have the interest paid and the interest paid. Makita ra ni siya yung unsay kaning components ani niya kay naman siya sa notes. Sa notes 28. Paragraph 33. Interest paid and interest and dividends received are usually classified as operating cash flows for a financial institution. However, there is no consensus on the classification of these cash flows from the other entities. Interest paid and interest and dividends received may be classified as operating cash flows because they enter into the determination of profit or loss. Alternatively, interest paid and interest and dividends received may be classified as financing cash flows and investing cash flows respectively because they are costs of obtaining financial resources or returns on investments. Sa among evidence also na the Coco Life have the interest received and dividends received. Next, paragraph 34. Dividends paid may be classified as financing cash flows, where they are a cost of obtaining financial resources. Alternatively, dividends unpaid may be classified as a component of a cash flows from operating activities in order to assist users to determine the ability of an entity to pay dividends out of operating cash flows. But ang Coco Life, wala sila dividends paid. Paragraph 35, cash flows, kaning paragraph 35 and paragraph 36 are related. Let's have first the paragraph 35. Cash flows arising from taxes on income shall be separately disclosed and shall be classified as cash flows from operating activities unless they can be specifically identified with financing and investing activities. And paragraph 36, taxes on income arise on transactions that give rise to cash flows that are classified as operating, investing, or financing activities in a statement of cash flows. While tax expense may be readily identifiable with investing or financing activities, the related tax cash flows are often impracticable to identify and may arise in a different period from the cash flows of the underlying transaction. Therefore, taxes paid are usually classified as cash flows from operating activities. However, when it is practicable to identify the tax cash flows with an individual transaction that give rise to cash flows that are classified as investing or financing activities, the tax cash flow is classified as an investing or financing activity as appropriate. When tax cash flows are allocated over more than one class of activity, the total amount of taxes paid is disclosed. So we have inserted the evidence. Coco Life has cash paid for income taxes. Paragraph 37. When accounting for an investment in an associate, a joint venture or subsidiary accounted for by the use of equity or cost method, an investor restricts its reporting in the statement of cash flows to the cash flows between itself and the investee, for example, to dividends and advances. Paragraph 38. An entity that reports its interest in an associate or joint venture using the equity method includes in its statement of cash flows the cash flows in respect of its investments in the associate or joint venture, and distributions and other payments or receipts between it and the associate of joint venture. So, ang Coco Life, wala sila percent of interest in associates sila cash flows. Paragraph 39. The aggregate cash flows arising from obtaining or losing control of subsidiaries or other businesses shall be presented separately and classified as investing. Paragraph 40, an entity shall disclose in aggregate in respect of both obtaining and losing control of subsidiaries or other businesses during the period of each of the following: the total consideration paid or received, the portion of consideration consisting of cash and cash equivalents, and the amount of cash and cash equivalents in the subsidiaries or other businesses over which control is obtained or lost, and lastly, the amount of the assets and liabilities other than cash flows, cash and cash equivalents in the subsidiaries or other businesses over which control is obtained or lost, summarized by each major category. Paragraph 40A. An investment entity as defined in IFRS 10 consolidated financial statements need not apply paragraphs 40C and 40D to an investment in subsidiary that is required to be measured at fair value through profit or loss. Paragraph 41, the separate presentation of cash flows, effects of obtaining or losing control of subsidiaries or other businesses are single line items, together with the separate disclosure of the amounts of assets and liabilities acquired or disposed of, helps to distinguish those cash flows from the cash flows arising from the other operating, investing, and financing activities. Paragraph 42, the aggregate amount of the cash paid or received as consideration for obtaining or losing control of subsidiaries or other businesses is reported in the statement of cash flows, net of cash and cash equivalents acquired or disposed of as a part of such transactions, and events or changes in circumstances. Paragraph 42A, cash flows arising from changes in ownership, interest in a subsidiary that do not result in a loss of control shall be classified as cash flows from financing activities, unless the subsidiary is held by an investment entity, as defined in IFRS 10, and is required to be measured at fair value through profit or loss. Wala man nag-change of ownership ang Coco Life, so wala mi provide of evidence. Paragraph 42B, changes in ownership, interest in subsidiary that do not result in a loss of control, such as the subsequent purchase or sale by a parent of a subsidiary's equity instruments, are accounted for as equity transactions, unless the subsidiary is held by an investment entity and is required to be measured at fair value through the profit or loss. Accordingly, the resulting cash flows are classified in the same way or other transactions with owners described in paragraph 17. So it's talk about po na changes of ownership, which is wala nag-change of ownership ang Coco Life. Paragraph 43, investing and financing transactions that do not require the use of cash and cash equivalents shall be excluded from the statement of cash flows. Such transactions shall be disclosed elsewhere in the financial statements in a way that provides all the relevant information about those investing and financing activities. Next, paragraph 44. Many investing and financing activities do not have direct impact on current cash flows, although they do affect the capital and asset structure of an entity. The exclusion of non-cash transactions from the statement of cash flows is consistent with the objective of a statement of cash flows, as these items do not involve cash flows in current period. Examples of non-cash transactions are the acquisition of assets either by assuming directly related to liabilities by means of a finance lease, the acquisition of an entity by means of an equity issue, and the conversion of debt to equity. Paragraph 44A. An entity shall provide disclosures that enable users of financial statements to evaluate changes in liabilities arising from financing activities, including both changes arising from cash flows and non-cash changes. Paragraph 44B. To the extent necessary to satisfy the requirement in paragraph 44A, an entity shall disclose the following changes in liabilities arising from financing activities. First, the changes from financing cash flows. Second, changes arising from obtaining or losing control of subsidiaries or other businesses. Third is the effect of changes in foreign exchange rates. Fourth, changes in fair values and other the changes. Paragraph 44C. Liabilities arising from financing activities are liabilities for which cash flows were or future cash flows will be classified in the statement of cash flows as cash flows from financing activities. In addition, the disclosure requirement in paragraph 44A also applies to changes in financial assets. If cash flows from those financial assets were or future cash flows will be included in cash flows from financing activities. Paragraph 44D. One way to fulfill the disclosure requirement in paragraph 44A is by providing reconciliation between the opening and closing balances in the statement of financial position for liabilities arising from financial activities, including the changes in identified paragraph where an entity discloses such reconciliation. It shall provide sufficient information to enable users of the financial statements to link the items included in the reconciliation to the statement of financial position and the statement of cash flows. Paragraph 44E. If an entity provides the disclosure required by paragraph 44A in combination with disclosures of changes in other assets and liabilities, it shall disclose the changes in liabilities arising from financing activities separately from changes in those other assets and liabilities. Paragraph 45. An entity shall disclose the components of cash and cash equivalents and shall present a reconciliation of the amounts in its statement of cash flows with the equivalent items reported in the statement of financial position. So sa evidence therein we have the cash and cash equivalents at beginning year and the cash and cash equivalents at the end of the year. Paragraph 46. And in view of the variety of cash management practices and banking arrangement around the world, and in order to comply with IAS 1, presentation of financial statements, an entity discloses the policy which it adopts in determining the composition of cash and cash equivalents. Paragraph 47. The effect of any change in policy for determining components of cash and cash equivalents. For example, a change in the classification of financial instruments previously considered to be part of an entity's investment portfolio is reported in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors. And so far, wala may policy ang Coco Life in terms of cash and cash equivalents. Paragraph 48. An entity shall disclose together with a commentary by management the amount of significant cash and cash equivalents and balances held by the entity that are not available for the use by the group. Paragraph 49. There are various circumstances in which cash and cash equivalents balances held by an entity are not available for use by the group. Examples include the cash and cash equivalent balances held by a subsidiary that operates in a country where exchange control or other legal restrictions apply when the balances are not available for general use by the parent or subsidiaries. And the paragraph 50, additional information may be relevant to users in understanding the financial position and liquidity of an entity. Disclosure of this information, together with a commentary by management, is encouraged and may include the amount of undrawn borrowing facilities that may be available for future operating activities, and to settle capital commitments, indicating any restrictions on the use of these facilities. And C, the aggregate amount of cash flows that represents increases in operating capacity, separately from those cash flows that are required to maintain operating capacity, and the amount of cash flows arising from the operating, investing, and financing activities of each reportable segment. So our evidence is here. We have the increase and decrease of the following in operating activities. We have the net cash from operating activities, the net cash used in investing activities, and cash used in financing activities. Paragraph 51, the separate disclosure of cash flows that represent increases in other operating capacity and cash flows that are not maintained to operating capacity is useful in enabling the user to determine whether the entity is investing adequately in the maintenance of its operating capacity. An entity that does not invest adequately in the maintenance of its operating capacity may be prejudicing future profitability for the sake of current liquidity distributions to owners. In paragraph 42, the disclosure of segmental cash flows enables users to obtain a better understanding of the relationship between the cash flows of the business as a whole and those of its components part and the availability and variability of segmental cash flows. So our evidence here, we have the cash flows from operating activities and then the net income from operating activities. We have the cash flows from investing activities and the net cash used in investing activities and the cash used in financing activity. And that's all for our report on IAS 1 and IAS 7. Thank you for listening.